SoftBank gained more than 10% in a single session today, and the catalyst had nothing to do with artificial intelligence, earnings, or a product announcement. The trigger was a diplomatic agreement between Iran and the United States. If that sentence doesn't immediately make sense to you, that's the point. Markets in 2026 are pricing geopolitical risk into tech equities in ways that most retail investors are not modeling at all. So the real question is this: what exactly is the mechanism that connects a Middle East diplomatic deal to a Tokyo-listed tech conglomerate? And more importantly, how do you position around it before the next one? Let's start with the mechanism, because without it, SoftBank's 10% move looks random. It is not random. When a significant geopolitical risk event, in this case elevated tension in the Middle East, moves toward resolution, a very specific sequence happens in global capital markets. Risk appetite expands. The dollar typically softens against Asian currencies. Emerging market and Asia-Pacific equities see inflows as institutional allocators rotate out of the defensive posture they held during peak uncertainty. SoftBank sits at the center of this dynamic for a structural reason most people overlook. SoftBank is not just a Japanese telecom company. Through its Vision Fund vehicles, it is one of the largest concentrated bets on global tech and AI infrastructure on the planet. When risk appetite contracts, SoftBank gets punished disproportionately because its portfolio is illiquid, forward-looking, and heavily weighted toward growth assets that are sensitive to discount rate changes. When risk appetite expands, as it did today with an Iran-US agreement, the reverse happens with equal force. The same illiquidity premium that hurt it on the way down becomes a leverage multiplier on the way up. This is what a 10% single-session move looks like in practice. Now here's the actionable framing. Events like this are not one-off noise. The Iran-US deal joins a pattern of 2026 macro events, where geopolitical resolution is functioning as a global tech liquidity switch. Investors who are only watching earnings calendars and Fed meetings are missing an entire category of signal. The insight to hold: when you see credible geopolitical de-escalation headlines in regions that affect energy markets, the first-order effect is oil, but the second-order effect is risk appetite in Asia tech. And that second-order move tends to be faster and larger than most models expect. The second story running parallel to SoftBank today is arguably more structurally interesting for anyone watching the AI sector. Zhipu, a Chinese AI company, saw its shares surge as much as 48% after JP Morgan raised its price target. A separate headline notes the stock also gained 33% in a related move tied to what reporters are framing as Wall Street raising its bets on China AI following Anthropic curbs. Let's unpack what is actually happening here, because the surface reading and the real story are different. For most of 2025 and into 2026, Western institutional capital has been deeply conflicted about China AI exposure. There are genuine concerns: regulatory risk, geopolitical tension, access, restrictions on advanced semiconductors, and export controls that limit what Chinese AI labs can import. Anthropic, as one of the leading US-based frontier AI developers, represents a category of AI capability that US policy has been actively trying to keep out of Chinese hands. When headlines suggest Anthropic is pulling back from certain markets or access pathways, which is what the curbs reference implies, a counterintuitive thing happens. It signals to investors that Chinese domestic AI development from companies like Zhipu is not going to be simply outcompeted by unrestricted American imports. It creates a protected competitive environment. JP Morgan raising a price target at this specific moment is not coincidental. It reflects a reassessment of the moat around Chinese domestic AI players when external competition faces friction. A 48% single-session move tells you the market was significantly underpriced on this thesis before today. The actionable insight here is not to chase the move. It is to recognize that export control policy is now a direct variable in relative AI stock valuations. And when that policy shifts or tightens, domestic alternatives in restricted markets reprice fast. That's a pattern worth tracking systematically, not reacting to after the fact. This is analysis, not a recommendation, and none of this is financial advice. The third data point in today's cluster of headlines is SpaceX, which is reportedly set to extend a rally following what Reuters describes as a record Wall Street debut. This one deserves careful framing because SpaceX's public market arrival is not just a single stock event. It is a signal about the state of private-to-public capital rotation in 2026. For years, the most consequential technology companies stayed private longer. SpaceX, Stripe, and a handful of others became the defining examples of companies that could access enough private capital through secondary markets, sovereign wealth funds, and late-stage venture that a public listing felt unnecessary. The fact that SpaceX has now completed a Wall Street debut and that it is rallying tells you something specific about the current capital environment. Private market valuations ran far ahead of what institutional public market investors were willing to pay. The rate environment and liquidity conditions of 2024 and 2025 forced a correction in that dynamic. Companies that wanted continued access to large-scale capital had to come to public markets on public market terms. SpaceX doing so and rallying means one thing clearly. There is institutional demand for hard infrastructure tech exposure that public markets have not had access to. This is not the same as a software SaaS company going public. SpaceX represents a category of capital-intensive, strategically irreplaceable infrastructure that sovereign funds, pension allocators, and large tech-oriented institutions have been underweight on because it was inaccessible. The rally extending past debut day suggests that demand is not satisfied yet. The broader pattern to watch, SpaceX's successful debut, will accelerate the decision calculus for other large private tech and AI infrastructure companies that have been weighing public markets. The pipeline behind this is significant. When category-defining private companies go public and immediately reward buyers, it changes the risk calculus for the next company in line. That rotation, from private to public, is one of the defining investment infrastructure stories of 2026, and today's headline is an early chapter, not a conclusion. We opened asking why a diplomatic deal between Iran and the United States moved a Japanese tech conglomerate 10% in a single day. The answer is that geopolitical events are now first-order liquidity triggers for global tech, not background noise. GPU confirms that export policy reshapes AI stock valuations faster than earnings do. SpaceX confirms the private-to-public rotation is real and has demand behind it. The follow-up question: which private AI infrastructure company goes public next? And is the market ready to price it fairly? Subscribe so you don't miss that analysis when it matters.